Hackers, it's Chris with Life 180. I am here with Dom from And Asset, Better Wealth. You kind of do both, right?
All the things,
All
yes.
the things. You guys probably seen this stud on his channel doing videos. I noticed a video of you. Was it on? I don't remember where I saw it. It was either TikTok or Instagram, I think. But you were doing something that I've been thinking about doing for a long time, and I was like, "Oh, that sucker did it! That's awesome, good for him." You were going through the streets, like talking to people randomly about money stuff.
Yeah, those get a lot of views, a lot of
They're
eyeballs. I was
amazing,
like,
man.
wow.
I've been wanting to do that forever. I hired a video guy last year, and then he had to quit. But the goal was to like go through downtown Phoenix and ask people questions about their understanding of different financial concepts to see like kind of what's what, and
Yeah,
I think it'd be good, but
it's a lot harder than it looks because you have to ask 30 people and then you get 2 people to say yes, right? It's well,
yeah.
depending on the time. Like I probably could have chose a better time when I did it, but yeah, it is a very powerful, but it is tough. But yeah, I'm glad that beat you to it. No, I mean, there's plenty of room to go around. You can still do it. You can still do it. I think you should.
That's awesome. That's awesome, man. Well, it's awesome having you here. We were just talking a little bit before starting this video. One of the things I love with you and Caleb and what you guys are doing, what we're doing, is I just feel like we're so aligned in like how we talk about this stuff and what our beliefs are around just the role of whole life insurance, I guess, from a simplistic perspective. The role that should play, or the different types of roles that it can play in people's lives. And there's a lot of misinformation, half-truths, deception. Everybody's a little different, right? Like I think some people are being nefarious and deceptive, and some people are just naive and uneducated. And, you got the full spectrum of like really what's happening. But at the end of the day, what we have is this revolution of short videos on TikTok and Instagram that are building a lot of traction and a lot of exposure for whole life insurance, infinite banking, all these different things. And that exposure, in my opinion, while it's kind of fun and sexy in a way, because it's like bringing a lot of awareness to the concept as a whole, it's also bringing a lot of potential danger, because you can explain this stuff in a 60-second clip. And I would venture an argument, like maybe you could pull off, like you and I could probably sit here for a half hour and come up with like, all right, what are 3 or 4 or 5 60-second clips that we could do that would like be really articulate or whatever. But they wouldn't be sexy and they wouldn't get a lot of traction on social media platforms, right? The people that are utilizing social media to really crush with the infinite banking stuff, it's a lot of half-truth going on, or a lot of like unfinished conversations, let's say, right? Like as far as like explaining how this stuff really works. And I know you and I both share this passion for educating people in the business and educating clients, and you're not going to get educated on TikTok or Instagram. And that's why we probably stick to YouTube more than anything. But what's your take on all that?
Yeah, I've actually have tried to remove myself as far as possible from the brand of infinite banking, mainly not due to infinite banking itself, but because of the way that's being portrayed on the internet. And when I go through TikTok and Instagram Reels and I watch this information, it like really makes me cringe. It makes me cringe hard, because what's happening is what is being spoken about is essentially, like you said, half truths, right? And so like when people say, hey, you pay yourself back with interest, like I instantly like just like cringe across the board, because that's how I heard about it. And that's what got me excited. And then I had to go through this whole loop-de-loop of a year of like, what does it mean when you pay yourself back interest? Like, what does this actually mean? And you think that you're like making more money than you are. It's like, well, what financial product, like why wouldn't I want a product where I essentially am borrowing money and then I'm paying myself back the interest? And does that mean I'm getting like triple the interest? And so when I hear that stuff, it just
sign me up.
Yes, it just it bothers me tremendously. And I think we as advisors and people in the space have a fiduciary duty, even though we're not technically fiduciary bound, to essentially educate people in regards to how this stuff really works. Because if we don't, What will end up happening is 5-10 years from now, people are going
Mm.
to get more and more into it. Policies are going to lapse. People are going to realize it doesn't function the way that they thought it was going to function. You see now insurance carriers like Mass Mutual coming out and saying, hey, we don't want this business because it's adding a negative debt to essentially their balance sheet, and it's causing them more
Yeah.
problems on the back end. And essentially is going to be a spiral effect where it's going to affect the people that are doing it right. And so
Mm-hmm.
if you look at the YouTube channel, I have videos where I've talked about like debunking infinite banking, why agents are going to screw you over, why I hate infinite banking. And I feel bad to some degree because I know Nelson Nash necessarily didn't want it to come down this path. He didn't want it to essentially get this far, but
Mm.
essentially here we are. And from that standpoint, we have to do our best to avoid that. So,
Yeah, it's interesting. I think if Nelson were still alive, it's too bad he passed away at like the wrong time, like right before like the social media TikTok revolution like really took off and people started doing this, because I think we'd probably have a lot more content and a lot more creation from him, like setting the stage right, and unfortunately, like the timing of it was like perfectly wrong.
well, you know what's crazy about that is they actually are doing think tanks with the whole infinite banking, foundation and institute.
Hmm.
Do them
Yeah.
once a year. And from I haven't been, and nor will I go.
Hmm.
But what I hear about them is that you have to be IBC certified, and I'm not IBC certified, so I wouldn't even be allowed to go. But what I hear is that from the president and the CEO and the people that are of leadership,
Yeah.
they're cracking down on people speaking around IBC unless you are IBC certified, which essentially
Hmm.
even means that people in the space that are like strong foundationally institute people around infinite banking are seeing the same problem. And so they're like now saying, hey, like if you're not IBC certified, don't speak around this because there's so much misinformation. The problem is even the people that are certified are still speaking really bad about the product and giving misinformation. So that's where I think it becomes a problem as a whole. And you can't really
Mm.
crack down on it. What are they going to try and do? Like sue everybody that says it? Like, obviously they're trying to hand slap people like, hey, you can't say this or we can sue. But there's just too many people talking about it now. And now what's going on is now people are no longer even talking about whole life in infinite banking. They're talking about IUL in infinite banking, which in Nelson Nash's book specifically, he talks about how you should never use UL in regards to this concept. So which makes
Hmm.
it even more dangerous when we're starting to talk about how IBC was originally created.
But IUL is not UL, right? I mean, that's what all the IUL agents would say. IUL is different. It's an advanced, it's an enhanced product that Nelson Nash just wasn't aware of. Dom.
If IUL is enhanced, it just means enhanced more problems. You uh, yeah, it becomes tough at the end of the day. And when I first got started in the industry, I kind of lumped it together with what we're doing and what we call it the and asset. I was like, at the
Mhm.
end of the day, like it's all the same thing. Essentially, when you borrow against your policy and use it for something different, that's infinite banking, and we brand it as the and asset, and that's what the and asset really is. And like I
Mhm.
start to now think about it, and it's more of a philosophy of how essentially you use your money. And I now
Mhm.
actually truly believe that the end asset and cash flow hacking is not infinite banking because of the
Mhm.
way that infinite banking is essentially sold and taught, and the way that actually foundationally, even the policy structure, the way that they now there's a guy that's in the space that actually talks about infinite banking correctly, which he's older gentleman. I think he's in like his 60s
I
or
know who
so.
you're talking
And
about.
so when he talks about it, I actually do listen to him because I respect him. And if
Yep.
everybody talked about infinite banking like he did, I think the industry would actually be really, really well, because he actually learned directly from Nelson Nash. And so he says that the people, like essentially us, that
Mhm.
design their bases lower than a 40/60, like because forty
Mhm.
sixty is like the baseline for in 40% base, 60% PUA. So base essentially the foundational of insurance, and then 60% being the PUA, which goes directly injected in cash. That
Mhm.
is the foundational for infinite banking. If people are doing anything lower than that on the base, so if you're going 30, 20, 15, 10, whatever it is that you're structuring the policy, that's no longer
Mhm.
infinite banking. And I was like, amazing. I now have permission, knowing that we don't design our policies 40/60 across the board, that we are no longer infinite banking, because we're even the way that we're designing our product is essentially different. So I actually really like that. I was like, man, I
That's
appreciate you
good.
for saying that. And it's actually, Bruce, if you're watching, appreciate you for paving the way in the infinite banking space.
That's awesome. Yeah, man. It's interesting that you say that. I did a video, at the time we're filming this right now, I did it probably a couple of weeks ago. And it was basically 6 things you need to consider when buying a policy, a whole life policy in general, and at the end of the day, policy design, the split of base to PUAs is just one of the 6, like there's so many things to consider, with the company and the design and like what you're really wanting this policy to do for you throughout the course of your life, that you need to take into consideration, and how all these things get, impacted. Um, you know, when you want to talk about the blend or the 40/60 or the 10/90 or the 20/80 or 30/70 or any blend there, why is 40/60 infinite banking? Like, what is the number? Like, what's the real math? What's the reasoning? Like, it's kind of like it's kind of like saying, well, it's the argument we make in mortgages, right? It's like you're saying, if we say, hey, you got to, it doesn't make sense to pay off your mortgage. Okay. If that's the case, then paying cash is bad. That means a 15-year mortgage is worse than a 30-year mortgage, right? Like, but like the principles are the principles. So if not going full base policy if going full base is worse than a 40/60, then wouldn't 10/90 be better? Like, where's the
Yeah. So
break?
here's where I think that they're coming from, and this also varies now per company because every company's products are so different across the board now. And every
True.
year they're coming out with new products. Every year they're coming out with new guarantees. They're coming out with new PUA load charges. And so because the industry is changing so much, and then when Nelson Nash came out with this, it was like forever ago. Right. And that's where I also came up with the video. I was like, well, there was one way, and I think the industry has changed. And we have to be able to innovate, but innovate within a framework. Like, it's not, hey, let's innovate and let's start doing the IBC with IUL. It's innovate within the framework of how essentially whole life insurance was positioned. And so once upon a time, and like I actually still see in certain softwares of certain companies that you can do a 40/60 without any term insurance on there. So, there's the structure standpoint of like you can do 40/60 with no term rider. So there's certain companies that can get that with no term. But the second you go to like 30/70, you have to put the term rider on there to prevent it from necking. So that's kind of my thought process of why they've created like this 40/60 being the structure that they stick with.
That's interesting. Okay, that actually makes a lot of sense.
Amazing.
Because that's the hard part. That is the hard part. Like, and I'll say this is like, I'm not a 10/90 fan, but I'm also not against 10/90. I'm like, my mindset is the policy that design that is best for you is the one that helps you kind of meet your goals and objectives, fits your needs. And sometimes it's a 10/90, but then honestly, sometimes if you got enough money to front load into a policy, a 10/90 doesn't make any sense. It's not impossible. And if it is, I was running illustrations with one of the lead like strategic guys at a company that I'm just not going to name right now, but it's one everybody would know, and it's like their front load charges on their PUAs are really high, like the highest in the business, and they illustrate really well still. But the problem is with a 10/90 policy, if you don't manage it right, it was funny. The quote of this from this guy at this company, it's so hard to not say the name of the company. From this guy, he said, if you don't manage this 10/90 right, like it's great if you're going to fund it and all these things, but if you don't manage it right, it becomes effectively like an IUL. And the cost of the term on the back end to support the 10/90, design becomes a drag on the policy into perpetuity, the same way that annual renewable term becomes a drag on an IUL policy. So it's very fascinating.
Well, it's because it's just a straight cost, I would assume.
Yeah.
But then that would also vary per company. And I would be interested to know what company you're talking about offline if you don't want to share it. Because there are companies that just do a straight term cost, right? And then there are some companies that essentially have the blended PUA term cost, where essentially part of that term eventually gets converted into PUA over time. So essentially it's like, well, that's another instance of like, I guess it depends, because you couldn't be able to say that across the board of every company. Maybe.
Well, and that's the thing, right? It's all different. Every company is different, right? And so you just don't know. There's no, and you hit the nail on the head. It used to be whole life was whole life was whole life. Every company, maybe the only difference was like, what's their dividend? And now especially after Section 7702 came out, and the guarantees anywhere from 2 to 3.75 now. And there's so much flexibility in some companies. It's not even a matter what company are you choosing. It's a matter of what product at what company are you using. Like every company has multiple whole life options to choose from,
Yeah,
and
no, it's true.
they all
It's
offer
true.
different flexibility of design. They all pay different commissions to the agents. They all it's all these different things. Like there's no free lunch in this game, people,
Yeah.
right? Like
It's so true. And like what you said, it comes down to depends on what it is the person wants, because you could have a good argument for having a higher base than essentially a lower base, because
mhm,
the more I dig into it, like having a higher base gives you the options for the future to essentially put in more money, right? If you
mhm,
have like a ceiling of 20 grand today and that's all you can afford, well then, your income may increase, and then you essentially created some space for you to put in 40 grand in the future by having a higher base. You do the
mhm,
optional lower base, you won't be able to do that. So like that's one way where you could essentially allow yourself to fund more into the future. I did a video. It's called the Bugatti of life insurance. And in that video, it shows when I start front loading, which is essentially injecting a large amount of money into the first year, you
mhm.
will have policies that will have a higher base that will perform better than a policy with lower bases, because you're putting in more money into it. The more
Yep,
money compounding at a higher rate essentially
bro.
will create better results. So it really does depend across the board. You have like a framework for, hey, this is how it should work. But then
Mhm.
at the end of the day, there is some nuances depending on what it is you're trying to do.
We did I did an illustration, and this is going into underwriting right now. They haven't like closed or anything, haven't been approved yet, but this is all just kind of give you an idea. We did a policy the other day that was 80% base, 80% base, but it was a $14,000 a year premium. But because we did 80% base, we were able to front load almost 200,000 into a
Mm.
$14,000 into a premium.
Yep.
You know what I mean? So like sometimes you run into situations like that, and
Yeah,
you
and
got
if
to
you
do
try
it
to do a 1090 in that scenario, the policy would mech, right? You lose out on tax
100%.
advantages. You just wouldn't be
Yep.
able to do it. And by
Right.
doing it that way with the 80% base and you do $14,000, the very next year, you're likely put in 14 and you're going to make 15 grand back.
Yeah.
Versus,
It was, yeah.
yeah, versus if you did like a 1090 and you just did 14 grand a year, it might take
Yep.
4 years before you to
Mhm.
start making more money than essentially that 14 grand that you put into it, right?
Right.
So there is some heavy advantages by doing it with a higher base with certain companies. Now,
Mhm.
again, that is a certain company dependent in what
Yeah.
that
Yeah.
looks like. So
Yeah.
there's just so many different nuances, which is why it's important to talk to somebody like you and your team to essentially say, hey, this is what we want to do. This is the money
Yep.
we have, the resources. What essentially does this look like? Because in what company would work the best for our scenario?
So talk to me. How do I put this here? So with all of the things going on in the world of life insurance and marketing of life insurance and the different messages and kind of half truths and everything that's going on out there, tell me what do you think the top two or three most misleading concepts that people need to watch out for are?
So I think the first one is coming back to you're paying yourself back with interest. I think
Mm,
that becomes one of the concepts that I think is misleading. And I don't know if it's people are intentionally misleading people or if what they're saying is they mean it, but they mean something completely different. And I think
mhm,
it can kind of come into the same bucket. Like if you're saying something and people think one thing, but but you're saying it another way, I think that's misleading. Right. And so if
yeah.
I say, hey, I pay yourself back with interest when I borrow against this policy, well, that sounds like I'm making the interest on my policy. But in
Mhm,
reality, if I were to break it down, what I think people are saying is that when I borrow from against my policy, I am paying interest back to the insurance company. But because I'm
mhm,
with a mutual participating company, I essentially am an owner of that company. And so when I
mhm,
pay the interest back to the company, it essentially improves their profits, which essentially I get a dividend based off their profits. So therefore, I get a bigger dividend in theory, which essentially means I'm getting interest, like higher interest, which means I'm paying myself back interest. That's what I think people are saying. I also think people potentially are saying is because it's simple interest, and when you pay it down, like the principal goes down, therefore you're like gaining interest back in like a different way than if you were to pay interest on something that is a different loan structure. But it's not very intuitive on what people are saying. And so therefore, miseducation is misleading, which I think is doing a disservice to the industry.
Yeah.
So that is, I think, the one of the bigger ones. I mean, it comes back to the same thing. Like, people are teaching, like, hey, I can take my policy and I can go buy Rolexes, I can go buy Gucci, I can go buy cars, I can go buy these other liabilities. And I can essentially get every single dollar that I ever put into paying for these things back. And I'm just like, whoa, 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 whoa. So what you're telling people and what you're teaching people is, I take my dollars that I've hard earned worked, they become taxed. I then put into
Mm-hmm.
a policy, it then grows, and then I pay that money. So let's just say it's 20 grand to go buy a Rolex. I
Mm-hmm.
then now will make that 20 grand back. And it's like, I essentially got this Rolex for free. Like, that's what I hear when I
Well, that's
essentially
what
do
it
that.
sounds like.
That's what it sounds like, right? And
Mm-hmm.
regardless if they mean that or not, which I don't think they do, that is the way that is being taught. And that's the way people think when they hear it. And if you actually like look at the comments of certain sections like that, people are
Yeah.
like, scam, scam, or they say, I'm more confused than ever. Like, it doesn't make any sense. Or people are like, I need to know more about this. Like, you kind of get
Right.
like across the spectrum. It's never
Yeah.
like, oh, like this makes perfect sense. Like this is like, I understand this now. Like, I know how to use this tool effectively and I'm ready to execute on this. Right. So that's where I think the disconnect comes from. And the biggest thing is just miseducation in the space.
So one of the phrases that's utilized a lot, and I guess actually I want to go here is um, just to kind of stack on to what you were saying. Simple interest. Everybody likes to say, oh, it's pay simple interest while you're earning compounding interest. Like that's the thing. I got news for you. If you don't manage a simple interest, it becomes compounding interest. Like
100%.
and nobody seems to want to talk about like the
100%.
responsibility from this is why I say, and I know you do the same thing, let's educate people, not market to them. Like, instead of just making statements like that, why don't you just like teach people how it works, right? Like,
Yeah.
and I don't know why that's the case, why people do that, but like, I guess it's just clickbait, and it just gets views and moves faster, and the attention span of people, I have no
Yeah.
idea.
What's actually fascinating is, sometimes I hear them teach, at least, you got to be you got to be a good banker and you got to pay your interest back. Like, they'll say
Take
that.
control of the banking function in your life.
Yeah. It's always super fascinating to me, because if you were to get a loan for
Yeah.
like your HELOC, or like
Mm-hmm.
you were to essentially get a loan from somewhere else, you would never
Mm-hmm.
say, I'm taking back the banking function, I'm going to pay interest back to myself with my HELOC. Like, you just don't say that, or I'm going to pay this interest back to the bank. But
Mm-hmm.
when you have a policy, it's with the insurance company. It's just a different vehicle than a different vehicle over
Mm-hmm.
here. So it's like, wow, why don't we say that? It's like, if I get a loan from the bank, why aren't I saying I'm paying back my essentially banking function with my bank that I'm borrowing from at the end of the day? Because the insurance company is just another business. They're another corporation that you're just borrowing money against, that you're essentially paying them back that interest. Because you can collateralize even a CD when you start to think about certain things. You
Mm-hmm.
can collateralize a CD. That CD can keep growing while you essentially borrow against it, and then you can essentially pay it back when
Sure.
you essentially want to, right? The only difference in that scenario is you don't have a death benefit, right? And the death benefit is obviously going to be a whole nother beast of why it can add to your legacy and your foundational portfolio. And CDs
Mm-hmm.
aren't always going to be at the rates they are at today. Sometimes, like if you look a year ago, CDs are at 1% at most, half
Yeah.
a
Yeah.
percent. You're
Yeah.
always at least having good, great, consistent compounding within like a whole life contract.
Yeah. I mean, at the end of the day, the whole idea of like using a life insurance policy as a banking alternative is like, I mean, listen, we've all kind of like done it. I've been guilty of utilizing that phraseology, but at the end of the
Yep.
day, it's really not a banking alternative. It's just a financial account that puts you in more control to be a better consumer, to be a better producer,
Exactly.
to make better decisions, to,
Yep.
like it puts, like when we talk about taking control of the banking function of your life, the biggest challenge that I have, and the main reason I won't get IBC certified personally, and I'm going to ruffle a lot of feathers with this, right? Like, is because of the foundational principle and kind of the naivety of thinking you're going to eliminate the role of banks in your life to a full extent. Like, to me, I don't want to deal with the inconvenience of life, of like thinking I'm going to get rid of banks out of my life. Like, that idea is a little bit too, I don't know, extreme for me. Like, I'm looking at it from the perspective of, taking control of the banking function in my life, meaning I want to have enough money in my whole life policy that gives me control. That way, if I borrow from the bank and I leverage my whole life policy as collateral or whatever it is, and I have it there, well, now I'm in control. Like, I get to negotiate from a place of power. If I take the loan from the bank, if I can get a loan from a bank at 2% and pay 5% or 6%, if I would pay the insurance company 5 or 6%, why would I not take the 2% from the bank if I've got all this money sitting over there? I'm still in control of the banking function.
Yeah.
I mean,
if it's in a line of credit form, right? If it's in a loan form, I understand the argument. What I mean by that is, in a loan, if you get a $20,000 loan, regardless if you pay $10,000 back, you're still paying interest on the $20,000. In a lot of scenarios, because it's just, you don't bring the principal down and pay less on that loan. It's essentially the same amount across the board. But if in line of credit, like when you pay the money back, the actual principal that's being compounded on that would essentially decrease. At least
most loans, like if I get a car loan for $30,000, and I could go get a car loan for 5 years for $50,000, and it's like a $800 a month car payment or something like that. If I could go to the bank, and let's just say the price of the car is what it is, and we don't have the ability to negotiate that, and it's all things being equal. If I can get a 0.9% rate with the bank, and I'm paying amortized on that, like, I'm going to take that over 6% with my whole life policy all day long.
100%, right? I mean, and the other thing you're doing is, when you actually use your policy for loan functions like that, you're also losing the control of what it is you could do with that. I think is the more important function of that. Sometimes we neglect. So people talk about using your policy for liabilities and cars and stuff. Well, if I do that, well, now I limit how much wealth I can build. So it's like, cool, you can be very middle class, and you're essentially, I feel like when you do this, you just follow in the bucket of Dave Ramsey. Like, you're just essentially thinking very minimally. But like, you start to talk to like really wealthy people, or like even follow the rich dad poor dad philosophies. Like, the best case scenario, what you would do is you would essentially start a whole life contract. You would then buy assets like how you do in Cashflow hacking. That's like real estate. And then now you have multiple assets that are producing multiple benefits. You got the appreciation, you got the depreciation tax wise. You essentially have cash flow. You have a tax advantage, all of these different functions that are happening. And then when the cash flow comes in from your real estate, you can essentially use that to then pay for liabilities. So it's like, why wouldn't I do that versus like taking my policy and putting it in for my car? Like, it just doesn't make sense to me if I'm building real wealth. And nor ever would I like be talking to like Warren Buffett of the worlds and be like, hey, like, you should probably use your whole life policy to buy your vehicle. It's like, no, like, I'm going to go buy some assets, and then all this cash flow that I'm getting from all these other assets, like, then I will use that to pay for my vehicles and my lifestyle, et cetera.
Totally. No, that's awesome, man. Well, tell you what, man, it's been fun. I feel like we need to do this more often. I've been texting you for weeks being like, we need to do this. And,
yeah, I'm always like, hey, you have my number, hit me up. And then you just get so busy because you're traveling the world, Dominican, getting tan, living the dream, going to baseball games, essentially living the life that everybody wants. You're living intentionally. We teach you better wealth to live people intentionally, and you're the epitome of that. You should just put you as the poster child of it. Thanks, Kirkpatrick equals living intentionally.
Right, exactly. No, man, it's super cool. Like, at the end of the day, I'm kind of in this. I've been going through all this process, thinking about all the marketing and all the, like, what's happening in our industry, and talking to thought leaders. And I just spent a day filming with Garrett. I was in his studio for like literally almost 14 hours one day, and we just filmed. It was awesome, man. I met a guy in doing video with Garrett for the day. I'm like, man, I finally met a guy that can like keep up with me and just video all day long and not stop and not need a break and just keep going. And we just were like on fire the whole day. And I'm like, man, this is like my heaven. It was
amazing,
awesome.
because every time I see you out and about in like different states and events and stuff, you're always doing videos and recording and doing lives. I'm like, Chris, you don't ever stop, huh? It's like, no wonder why your channel's where it's at and people love you, because you're just constantly putting out that value.
Well, love me or hate me, I got plenty of the hate on the other side. You don't see all the comments that I have to delete on my channel that never make it to the public waves, because they're pretty nasty.
Pretty
But it is what it is. It is what it is. I'm passionate about what I do. I love what we're doing, and I love what you guys are doing. And so anytime we can collaborate, I think the world needs Dom making a video a day. That's what I think.
That's a lot of it's a lot of Chris Kirkpatrick vibes right there, which is
I know the
essentially just
world
like
needs
crushing it.
Dom making. I want everybody in the comments below to follow the And Asset channel if you're not already, and I want you commenting below telling Dom he needs to make a video a day because this industry needs him to step up and do it. Not that you're not doing a lot already, but
I appreciate that. Love
just
that.
saying.
Love the love.
So,
love the love.
All right, guys. Well, I tell you what, that's going to be it for today. Hopefully you found value in this. Like I said, I'm going to put the link to the And Asset channel and the Better Wealth channel. So go check them both out. I think you'll see Dom's pretty face on the And Asset channel, maybe more often than the Better Wealth channel, but he's on both. He's on both. But check them both out. Obviously, I've done a lot of videos with Caleb over the years. They're like family to me. I love what they're doing. And so follow them. And if you want, leave a comment in the comment section below. I obviously do the best I can to respond personally to every single comment. I really do that. My wife sometimes tests me out and comments on a video just to see if I'll respond to her before a text message. And I typically do. I'm better with YouTube comments than I am text messages. So if you ever want to get a hold of me, that's how you reach me. Just leave a comment in the YouTube thread and I will respond. And so that is it. Until next time, have a blessed, inspirational day. We'll talk soon. See you.